I think I'm gonna send out. I'll send out the Chapter 4 exam. It'll be due in a week. Due on June 25th. Okay. That is not a 25th. That was 2 days in the past. Let me try this again. There we go. All right, so those are going to do for today. And this should finish up Chapter 4. Next class, we will start in on Chapter 3. And not to be a wet blanket or anything, but try not to miss the start of Chapter 3. It's one of the more difficult chapters. It's all about journal entries and difficult journal entries at that. So starting that's Chapter 3 next Tuesday. Today, 17th. Okay. Let's get rid of that. All right. So classified balance sheet. It's all about putting things where you think you put things that are similar together. An example would be a non-account example would be if let's say I go to a store and I want to find Cheerios. So trying to find Cheerios, where do I go? I want Cheerios. I'm gonna sit down and start crying if I don't find my Cheerios. Where in the store would I find Cheerios?
Where all the cereal is.
Cereal aisle. Now notice I didn't tell you what store it was, but we all know every store has a cereal aisle that sells cereal, and so you go to the cereal aisle. Everyone knows that. Same thing on the balance sheet. We're going to put things that are similar, things that go together. We're going to put them in the same spot, so that when someone's looking for them, they'll know exactly where to look for them. So that's all the classified balance sheet is. It's classifying, but it's kind of like just sorting out things that are similar. Like in the store, they have cereals together and soups together and all that kind of stuff. Exact same idea. So that people, when they're looking for something, they'll know where to find it. So anyway, let's go ahead and get started. And I got to pull up the. Okay. Hopefully everybody has the. I gotta move this thing. Chapter 4, classified balance sheet. This is handout 2. I should put that on here. I should put handout 2 on it. Okay, so basically we have a bunch of things that we sort out and put things that are similar together. So under assets, we have 5 categories. Oops. So we sort out the assets into 5 different categories. They're still assets. They're absolutely the same assets we had before. And you'll see cash, accounts receivable, all that, land, building, all that kind of stuff. These are all things that we had before. It's just that they are in a they're put into categories in the same, for the same balance sheet. I thought I had this thing worked out here. So something happened in the. Oh well. Okay, and we do kind of the same thing for liabilities. We have current liabilities, which we'll talk about, and we have long-term liabilities, which we'll talk about. And then we also have the equity section, and the equity section just sits there like a lump. There's nothing special about the equity section. We don't categorize it or anything like that. So the equity section just kind of sits there. But the assets and liabilities, we break them out. Okay, excuse me. So let's talk about that first. Let's talk about current assets and what they are. And I'm not going to, as far as definitions are concerned, I'll write up something here. Let me write up something on it. And I'll tuck it right in here somewhere. Okay. Again, you do not need to write this down. Okay, current assets. Are assets will be used or turned into cash within 1 year. Okay, so current assets. Our asset will be used or turned into cash within 1 year. So this is sometimes considered what we call the short-term assets. These are short-term. In the next year, these are going to be used or turned into cash. Okay. How many accounts receivable did this? My formatting is not really. Oh, come on. Oh, it must be up here. Okay. Sorry about that. So cash is already cash. Cash is already there. Accounts receivable is going to be cash. Right? It's going to turn into cash. Allowance for accounts receivable. We haven't talked about this yet. This is in chapter, I think 7 or 8. I can't remember which one now. But it's when we don't collect. Some accounts receivable you may not be able to collect, and that's what this allowance is for. In other words, some of these accounts receivable are not really collectible, so we reduce it. Marketable securities and short-term securities do the same thing. These are investments in buying stocks. So if you buy stocks of another company, oops. So you have your company has some money laying around and they want to invest, they buy stocks, say. It could be IBM or whatever. So marketable securities, and this is the new terminology, is marketable securities. You'll sometimes see them called short-term investments, are exactly the same thing. Why the change, I have no idea, but regardless. So marketable securities and short-term investments are exactly the same thing. And it's for investments that you plan on only and holding for a year or less, basically. So these two are exactly the same. They're just different terms, the same thing. Okay, supplies, things to be used up usually in a year. Inventory will usually be sold, prepaid. Those are all current assets. So these are all current that we turn into cash within 1 year. Going to current liabilities. Current liabilities is similar to current assets, except that instead of being turned into cash, they'll be paid or earned within 1 year. Oops. Oops. Okay, so current liabilities, very similar to current assets. Oops. So current liabilities are liabilities that we be earned as in unearned revenue or paid as in the payables within 1 year. So current assets and current liabilities kind of go together, and they're both similar, that they both have a time frame of 1 year or less. Everything else on the balance sheet is long term. So, you can actually, I don't know if I can put anything in there or not. Whoa. Okay, apparently I can't do this without really messing things up. So, best thing to do is just nothing at all, I guess. No, so there's kind of a line here, though. Maybe I'll use my space bar. These are all short term, these up here. Oh, I know what I can do. There, that's better. Okay, so these are all things that'll be are short term. They're within 1 year. So current assets and current liabilities are all within 1 year. As you may have guessed already, that means that these are things I can't format. I'll just delete it. Okay. Here we go. Okay, so on the balance sheet, current assets, current liabilities, these are is this thing a pain? These are things that will be used, earned, or paid within 1 year. They have a very short-term outlook. Everything down below here is long-term. This is all long-term stuff. And unfortunately, because I put this thing around it, I can't click on that. So I have to take off my hard-earned thingy. Okay, so everything up here is short-term. Everything on here is long-term. Long-term investments. These are when you buy an investment for a longer period of time. So buy stock and you're going to hold on to it for more than 1 year. Similar to the marketable securities or short-term investments, except you're going to hold on to it for a longer period of time. Land held for future use. I think I'm going to postpone that and go to land, property, plant, and equipment down here, and I'll come back to that one. Okay, land, property, plant, and equipment. You guys have seen those a million times, and that is usually the one of the biggest things that you'll see of a company. If you think about a Walmart, if you think about the Walmart store, this is kind of what you're thinking about. There's the land that the store is on, there's the building, and inside they have shelves and all that. There's some inventory in there too, but when you look at a company, most of the time you look at their property, plant, and equipment. That's what you're seeing. You don't see their investments or anything like that, but you'll see the land, building, equipment. Okay, land held for future use. I'm going to switch to doggy cam. And the doggy cam.
¿Por qué está de la Zoom también a Miriam and Ayani? ¿Por qué estás haciendo esto, hija? Están en el Zoom, miren. ¿Por qué están de tu teléfono así?
All right. So here's kind of what they're talking about for some investments things. Ooh, that's not okay. Let's do this. Okay, so let's say that your company has a building and it's on some land. All right, so building land. So this would be in your, let's say you're using the building and you have land underneath the building. Those will both be in property, plant, equipment. Oops. Property be the land, and plant of the building, and whatever equipment. Okay, now suppose that this land next door becomes available, and you say, well, okay, we should probably buy that land because if we want to expand our factory here, we might need that land in the future, but we're not going to use it now. So this land is not in use. It's really not one of our property, plant, and equipment because this is stuff that we're using. So say, what is this? Well, this is going to be an investment. Because it's actually not being used. Everything in property, plant, and equipment must be being used in the business. So if you have land that's not used, it is going to be in the investment account. Okay, so going back to this. So land held for future use. You know, if you're wondering what's the difference between, I shouldn't say green here. Let's do something different. If you're wondering what the difference between these two lands are, that's the difference. This land we're using, this land we're not using yet. Intangibles are all those things that have a value, but the value is not in a tangible form. Kind of like this. If you have let's say you have a patent to make something. Okay, so let's say that there's a patent. You know, here's my patent. Okay, and my patent is going to be for you know, whatever. So my patent is for the right to use a process or an idea in some way, some novel way. So maybe you have a new way on the internet to access your, I don't know, to access your bank statement or whatever it is. Okay, there's a patent. Now the tangible value is not in the patent itself. You know, here's the patent. You know, it's on a piece of paper. Well, this piece of paper is virtually worthless. So the value of the patent is not in the paper. It's because you have this protected thing, this protected idea that you can use. So intangibles are those things that you are not building, land building equipment, all that kind of stuff. They have a value. Sometimes they have a huge value, but the value is not tangible. You can't put your hand on it, anything like that. Pharmaceutical companies that make medicines, medical companies. You know, when they come up with a new medication, they're given a patent on it, and they are the exclusive seller of that medicine for a certain number of years, and those things can be worth billions. If you look at a company that is in medical research and that sort of thing, you look at their balance sheet, and they will have most of it will be in these intangible assets. It's kind of strange, but that's you know, that's a very common thing to have happen. So anyway, these are some of the ones that you'll have. Copyrights, if you write a computer program or if you write a book or something like that. Goodwill is an odd one, which we're not going to talk about it here. Trademarks, franchises, all those things are intangibles. Other assets, any asset not listed above. You say, well, what How about an example? An example of that might be this is having a table here would be a benefit, but it really isn't. Oh, yeah, down here. I'll put it down here. Okay, another asset. Let's say you have a delivery truck, old delivery truck. Let's say you have an old delivery truck that's not being used, it's available for sale. So you have this delivery truck, you're not using it anymore, you're trying to sell it. That would be in other assets. Until, when you sell it, it turns into cash. The cash would just be a little current asset. But this old delivery truck, you're not using it, so it's not going to be in property, plant, and equipment. And you're just trying to get rid of it. So that would be another asset. Okay. Long-term payables are things that are paid in more than 1 year. So this will be greater than 1 year. So if something is payable in 2 years or 3 years or whatever, it'll be a long-term liability. I gotta get the spacing here on this one. Sadly, I thought that this one was going to be my better handout. Anyway, so these are things that are payable long term. By the way, if you're wondering what a bonds payable is, a bonds payable is simply taking a loan and cutting it up into a bunch of little pieces. And a lot of times it's because they need a whole bunch of money. Yeah, let me do a right up here too. There it is. Okay. So here's what a bond payable is. If you have, let's say you have a loan, a mortgage for the bank. Oops. And let's say it's for $300,000. And that would just be a mortgage payable. You would sign the papers. And you would receive the cash. Okay, so this is a regular old mortgage. Sometimes, especially companies, they may have needs that are much greater than 300,000. Maybe they need 300 million. Right, and if they try to do that in a mortgage, they may have difficulty doing it. So they need $300 million for a big manufacturing plant. For one bank to write that would be kind of a lot of risk. So what the companies do is they'll change this to bonds. And bonds are like mini loans. All right, so maybe not a bond. Maybe they make a bond. Maybe they have a face value of say $1,000. Okay, so they're going to split this thing up between a bunch of little mini loans that are bonds. And, obviously, enough to get up to 300 million. So all bonds is sort of like a loan, but it's broken up into a bunch of little loans. So this is like its own little loan. Here's a little loan. And the advantage of that is you can sell these to anybody, anyone for $1,000. So maybe one person buys this, someone else buys 3 of them, and so on and so forth. They can all buy these little loans, basically, instead of having just one company write the loan. So bonds and loans are exactly the same thing. It's just you've taken a loan and split it up into a bunch of little bitty loans. But each of these loans, they have a value, just like the mortgage papers up here have a value, 300,000. These all have a value. They're valued at whatever it is they're going to pay. Okay. Preferred stock. I can't remember if we got into that on the first day. I think I'm going to skip going over that. Preferred stock is a kind of a wacky stock. It's between bonds and common stock. But on common stock, we also have a thing called additional paid-in capital. And that goes along with the common stock. I'll talk about that. Do we have, is it in here? It's not in there. We'll talk about it later. Retained earnings you've seen. Treasury stock is when a company buys back their own stock. So, for example, if this was IBM would buy back IBM stock. It would reduce the owners. This is going to be a negative. Okay, let's jump into our problem here. Okay, classified balance sheet. So these are all the accounts we have. It's in the trial balance like we did last class. And yeah, okay. So I tell you what, let's go ahead and do it up here. So looking at the assets, we have current assets, investments, property, plant, equipment, and intangibles. Okay, so which category would cash be in? Oh, come on, you guys know this one. Which category would cash be in?
Assets.
What kind of assets?
Current assets.
Yep. So this would be a current asset. I'm just going to say CA. How about? Okay, so this will be in the current assets. Accounts receivable.
Current assets.
Yep. Inventory.
Current assets.
Yep. Prepaid insurance.
Current assets.
Yep. Land. Land that we're using. plans being used in the business.
Property, plant, and equipment.
Yep. And by the way, a lot of times you'll see this abbreviated PP&E even in their financial statements. Okay, equipment. Same thing, property, plant, and equipment.
Yes. Okay.
Yeah. And the accumulated depreciation, this is going to be a negative, and this is going to go along with the equipment. So this will also be in equipment. Patent.
Intangible.
Yep. So they don't have any long-term investments. They don't have any other assets, but they have three categories: current assets, property, plant, and equipment, and then the intangible. Okay, down here, accounts payable. What will that be?
Current liabilities.
Yep. Salaries payable.
Current liabilities.
Yep. Ooh. Let's try this again. And unearned revenue.
CL.
Yeah, it would be in the current liabilities usually too. It's possible it goes into long term, but usually it'll be in short term. Yeah, it can go into long term. Say if someone buys a subscription for say 3 years, the first year's current, and the last 2 years would be longer term. Okay, bonds payable would certainly be long term liabilities. It's 8 years. This 8 years means it's long term. Hey, that one should be regular color. And stock and retained earnings, those are the same as before. It really, I mean, the balance sheet itself is exactly the same. It's just we have more categories. Assets are still assets. There's no, there's no change in that. Okay, so this is what we're going to do with this. We're going to kind of piece this together and put them into different categories, and hopefully we'll kind of see why here in a minute. Why are we doing this? Okay, so let's come down here. So current assets, well, let's get all these things that are current assets. And put them in current assets. And they don't fit. Oh well. I'm gonna leave them. Okay, so these are all of our current assets. And so we'll have a total current assets. There we go. So we'll add up all of our total current assets, and they come out to some number. We'll put on the doggy cam. $23,700. So these would be the total current assets. These are things that are going to be used up or turned into cash within 1 year. Investments, we don't have any, so this will just be none. Property, plant, and equipment, we have some. Oops, okay. All right. Let's see. 2840 and a minus 11,000. So this will give us our total PP&E, and again, you'll see that often abbreviated as this. $57,000. Intangibles, we have one. What the heck?
Yeah, I was thinking there's no number by it.
Okay.
Just looking at that.
I'm sorry. Oopsie daisy. All right, well. Yeah, that was, that's bad. Okay. If there was something in there, we put it in there. Okay, so total assets, I guess we only have the property, plant, equipment, and total current assets. So it'll be those two together. The 80,700, I think. Well, that's not very good. I'm gonna write that down. I had just worked on this handout. That's the embarrassing thing about all of it. Okay, so this is the chapter 4, handout 2. If there would have been something in there, there would be something in there. But all right. Coming over here, our current liabilities are these. Okay, so our total current liabilities. For all those. 5,300? 5,300. I'm going to stop right here for a second. You'll notice something about this that's kind of interesting. And that is our total assets, the total money we expect to come in is about 23,700. So that's what we're kind of thinking will be brought in at least at year end is what's on our books that will be brought in 23,700, and we owe 5,300. So does it look like this company is going to be able to pay their bills in the next year?
No.
Actually, yeah. I mean, if they get 23,000 coming in, and they got to pay out 5,000. They're probably okay. I mean, they're probably going to be able to pay off their bills at least in the next year or so. Whether they'll be profitable long term, who knows? But it looks like they're probably okay for this next year. They have this much coming in, this much going out, at least on the books at this point in time. So, and it's kind of one of the ways that you kind of use these. A regular balance sheet, it might not be obvious. But if you put it into this classified one, you say, okay, well, this is what's coming in, this is what's going out in the next year. It looks like they got it covered, at least to some extent, what they're going to be paying out. Okay, long-term liabilities. Bonds payable, 34,000. And you probably don't need to put a total there. I'm going to put it in, but there's only one. There's only one account. You probably don't need to do this one. And if it's like this, I don't know if I have this on the test or not. I'll have to look at it. So long-term liabilities, we have just the 34,000. By the way, here's kind of a heads-up thing, especially for those of you going into accounting. The question is, when do long-term liabilities get paid? Is it these liabilities get paid in 8 years? One of the kind of tricky answers is that long-term liabilities do not get paid. Because the long-term liabilities, after 7 years, this bonds payable is going to move into a current liability. There's going to be a current liability in 8 years for this bond. So actually, pretty much everything from the long-term liabilities, oftentimes anyways, when it gets near to being paid, will be shifted up into current liabilities, and then it'll be paid. So 7 years from now, this bonds payable will be moved into the current liabilities because it's going to be paid in whatever 8 years from now is, or 7 years from now. Okay, and equity is exactly the same. 8,000. 3,400. I better check on that before I do my adding. 3,400. Okay. total equity. We're doing 400. Maybe a little easier to look at. Okay. So whole thing here. Okay. So our total liabilities and owner's equity would be these two. You may put a line in here for total liabilities. Maybe I'll do that now. Sometimes you see companies do this, sometimes you won't. Another thing, a lot of times they won't actually label the long-term liabilities. It's another odd thing sometimes companies don't do. They have current liabilities, then they have kind of the rest of them. Okay, so total liabilities is what, 39,300? Okay, so okay, so total liabilities and equity. 39 plus 41 was 80,700. They do balance just like our other balance sheet. And so this is so where did they get the total assets? Just like before, it looks like they borrowed about 39,000, and the owners kicked in another 41,000. That's how I got about 80,000 of assets. So that's a classified balance sheet. Any questions on that thing? It's exactly the same as our other balance sheet. Assets are still assets, liabilities are still liabilities, equity is still equity. There's nothing that hasn't changed. It's just that we put them into more precise categories. You know, and probably the biggest ones are these two. You know, if you want to know like what companies or what people who analyze companies really look at, they really look at these very strongly, these current assets, current liabilities. Not that they don't ever look at the other stuff, they do. But this is one of the major reasons for this is to know, you know, look, are they going to be able to survive into the next year? You know, that's a big thing. You know, how well are they going to, how unlikely is it that they're going to be bankrupt, say, within the next year? And a lot of that comes from the current assets and current liabilities. There is some strange there's a strange thing with current assets and current liabilities that I'll go ahead and talk about it now. Sometimes companies that are run very well will actually have a lot fewer current assets than current liabilities. And the one that comes to mind most readily is Walmart. Walmart sells their inventory in about 30 days. Walmart pays for the inventory in 45. So Walmart will have 30 days of inventory on their books, but they have 45 days of liabilities for those inventory. They literally sell the inventory 15 days before they pay for it. So sometimes you'll have companies, if they're run very well, they'll have current assets that are less than the current liabilities. Now, usually you can figure that out from the income statement. You know, how much income are they making? If they're making a bunch of income, it probably isn't that big of a deal. That, you know, they have their current assets are smaller than their current liabilities. But mostly you're looking for current assets to be larger than the current liabilities. Question on that? Okay, so I think I'll send out a test. I think I'm just going to send out a test on the. I don't think I'm not going to put this on there. I'm not going to put the classified balance sheet on there. We'll turn this in. This will come as a handout for the class, but I'm not going to put a classified balance sheet on there. I'll just send it an accounting cycle one. And the accounting cycle one, I think, is it's probably more important, especially going into what we're going to do next in chapter 3 for adjusting entries, because the adjusting entries, a lot of times they'll show those with T account things like on our general ledger. So getting more used to using those is probably more important than, you know, categorizing here. And again, you know, if it's almost like baking a cake. Yeah, if you look at this kind of layout here for the, you know, it pretty much tells you where it goes. You know, so if you find some account, unless it's got some weird name, it's most likely going to be on here, and you can kind of figure out where it goes. That's not terribly difficult. All right. So anyway, I will be sending out. So let's go ahead and. I didn't save this yet, did I? Oh, and just to be clear, we are not going to do this problem. So we can delete that one completely because we're not going to do it. So the only thing we're going to do is this one. And again, it's done for a reason, classifying the balance sheet. But again, it's one of those things that actually of performing it, of actually doing it, it's kind of like baking a cake. You know, go get all the, you know, here's all the current assets, put those all together. Here's, you know, this is like stocking the shelves at the jewel store. You go, here's the Cheerios. Go put them away. Okay, where do they go? Cereal. You know, same thing. Where does the inventory go? Okay, current assets. Okay, so save that. And stop sharing. I never like sharing. Okay, so here's what I'm going to do. I'm going to put the chapter 4 handout 1 and handout 2 on in the drop. I'm going to also send out the chapter 4 exam, and all of these will be due on June 25th. Is that the same thing I wrote on the other one? I better check. Yeah, so all the chapter 4 stuff will be due on June 26th. No, 25th. Don't listen to what that crazy guy is saying. So everything we do on June 25th. Any questions? And chapter 4 of the accounting cycle is really just to get used to kind of the mechanics of it. Here's the journal entries that we know how to do, putting into the general ledger, trial balance, and then doing the financial statements, which we already know how to do. It's just sort of seeing the mechanics of how it gets from journal entry to the financial statements. Any questions on the chapter 2 exam? I think that I have that due tomorrow, isn't it? No, I didn't. It was due on the 22nd.
Tuesday, yeah, next Tuesday.
Yeah. Okay, so on Tuesday. Any questions on that?
Not yet. I haven't taken a look at it.
Okay, not a problem. All right, so we'll go ahead and meet next Tuesday then. If you have any questions, feel free to contact me. You get my cell phone, you get my email address. My personal email address there is there too if you have a problem with that. Roosevelt email address. And what else is yeah, so if you have any questions, we can if you want to go over something, we can meet other times too. Okay, well, I think that'll be it for this week then. And so so far we did chapters 1, 2, and 4, and we'll start on chapter 3, which is going to be a little bit confusing. But it is on the entrance exam into the graduate program. So even though I probably wouldn't put that on there, it doesn't make any difference because it's not my choice. So we're going to do it, and the adjusting entries. Okay. Well, I will see you guys on Tuesday.
All right, thanks. Have a good
Good
night.
evening. See you guys.